All right. Welcome, everyone. It's another Dfi-nancial Friday show. Welcome to the stream. We are live here. Again, my name is Alfred from Diversify Capital. Raymond also joining us as well on another Friday. What's going on,
Mhm.
Raymond?
Good, doing good. Every Friday
Yeah,
just keeps going by so
I'm.
quickly. Well, it
Yeah.
was a short week. There was a short week this week, so makes
Was
sense.
it? Because it felt long. All right. I
Yeah,
don't know.
yeah,
It
it's true
definitely
too.
felt long, and been just, man, I was up late last night. We were just talking about this. So I am running on a little bit of coffee and adrenaline. That's for sure. Ready for the weekend here. But we've got a fun show for us. We've got something where it's sneaking up on us. We've got taxes. And so we would be going over some top 5 tips of what we see people miss in terms of taxes, as well as some side on investing and how it impacts your taxes. So we call it cost basis,
Yeah.
but more so talking about as you're buying and selling stocks, what should you be worried about? Especially with a lot of us last year, the amount of people that got into trading was a lot larger than I think in many years. And I think that's a good thing.
Mhm.
But I think understanding the tax implications as you're trading out positions is going to be a whole different beast come tax time this year. So we're going to touch upon that for you guys today. All right. Of course, we're going to get into the market update too, talk a little bit about what happened this week, what we're seeing. So we'll get into some of that in just 1 second. As a reminder, right, we're live every Friday here at 3 p.m. So if there's anything that you guys want to ask us in comments, let us know. But we're always streaming here. So hit the subscribe button so you get notifications as we go live. And of course, right, anything that we talk about here on the show is really for generalized education and not for particular and personalized financial advice. We have a place for that, diversifycapital.com. Reach us there. We're about to launch a new video there showing you guys a little bit more about our services. So come check us out next week on it if you're looking for that video and see if that's the right fit for you. In fact, when we talk about investing today and about the taxes today, we're not acting as your tax professional here, right? That's something that you should be going towards your preparers with, or reach out to us again directly for that if you're our client watching. In general, we're just going through things that you should be watching out for when you're talking about your tax picture. Investing as well. We're not soliciting you to be buying any investments. Again, just giving you some general thoughts that we have around where the market is. All right. So another week, numbers a little different this week, right? I mean, we've talked about how markets have been on the upswing and they still have, right? That for the year, it's still positive. Things are going, well from a market standpoint. But I think, you know, you're seeing a little bit of what we've been talking about where stocks are high flying, the valuations, like if I mean, I don't know that you can use the word fundamental anymore. We certainly have not been using the word fundamentals around things like GameStop and AMC, right? But I
Mhm.
think a lot of what happened last year in the IPO market, and when I say IPO, initial public offering, when stocks are when a company is going public, a lot of those companies have done really, really well, maybe well exceeding what some of their earnings are. And a lot of the growth stocks, right, in NASDAQ did really, really well last year, 44% last year. Maybe this is the first week that people are like, oh, a little bit of a pullback in the market, right? As you'll see in the ticker below, right? NASDAQ was down 1.57% last week. So are we seeing some of that, Raymond? Are people maybe thinking about some of the data that's coming out and around just general economy and having people a little bit more worried?
Yeah, I think I mean, it's been a really great run, right, from what we saw from March and April of
Yeah.
last year, especially within the large cap growth companies that you've seen. I mean, there's still a lot of companies going public now and for this year as well, which generally points towards the sign that they're confident in the markets. But as of right now, I mean, just we're starting to see more volatility, and volatility doesn't always mean that it's going, just down.
Yeah.
It could be anyway, right? And that's what we saw this week in terms, even today. Market started off strong, but towards the end of the market day, we started to kind of dip back to break even today, right? So,
Yeah.
of what we've been seeing. So.
So yeah, I mean, certainly breaking some winning streaks in the market, at least in the S&P and the Nasdaq. But you're right. I mean, last year I've been sharing this with clients. We've shared this on the show before, but something like $460 billion of market cap, right? Of dollars being generated from initial public offerings last year. That was almost double what it was in 2014. And that was the last highest year. What that also means is a lot of the companies that went public, well, that money, that those shares were tied up for some time. A lot of that tie-up period or lockup period, we call it, is actually coming due right now. We're seeing some of these high-flying stocks where people, the employees or shareholders, have been able to sell 20, 30% of their shares, or in fact, some of them more than that, or fully unlocked. And I think you're seeing people say, wow, my shares are up 100% or 3 times what it was when it IPO'd. It's time to sell off. And across the board, I think you're seeing some of that as well. Just overall sell off on some of these higher names, IPO names, people finally realizing, right, their gains. What could potentially happen them from there, Raymond, is that maybe they're going to take some of that money and go back into other stocks, other more conservative positions, right? They had to redeploy the money in most cases, right? In our other webinars and our past couple webinars where we talked about real estate, you're seeing that too, where they're taking that money and redeploying into real estate. But not all of it goes in there, and a lot of it would go back into, I think, the stock market. So you have a lot of capital flows right now outside of just the general economy, right? And so, oh, might have lost you, Raymond, there. You're back now for a second. Yeah, I was like, I just saw like a blank stare at me, and I was like, oh, I think Raymond just either tuned me out on a Friday, right? Or
I just heard you stop talking, so I was like, "Wait a minute." He loves
what's new,
talking.
right? Anyways, but yeah, I think that's something that we're definitely seeing in the market right now, where people are being a little bit more aware again of these valuations. The pandemic has, of course, dragged on. So they're saying, okay, is this going to be something where the economy will still turn back around? So I think, that's coming back into question a little bit. Okay. All right. So what are we? Less than 2 months away from tax day?
Pretty much, yeah.
Yeah. And so we've got a little bit to chat about. Again, as I said, bringing you guys the top 5 things that we see people miss in their tax returns in just a little bit. But I wanted to start with, and Raymond wanted to start with, talking a bit about what it means when you sell stock, right? What it means when you sell investments in general. Okay. So there's a couple terms like cost basis, long term versus short term, and even things like are things even reported correctly on tax forms when you get it? So maybe, Raymond, you jump into a little bit. Tell me a bit about what you're looking for and talking about with clients as clients are coming to you and saying, should I be selling certain positions? What should I be worried about from a tax perspective?
Yeah, definitely. And the reason why we wanted to talk about this today, given that we're close to tax season, is that, as Alfred mentioned, I feel like there was a lot of new investors that started to put funds into the market around March and April when we saw that dip last year. So
Mhm.
we are coming around this magic number that we like to call as the 366 days, where that helped dictate whether your cost base is going to be considered short term or long term. Now, taking a step back, like what exactly is cost basis? So, cost basis is going to be the amount that you put in yourself as principal to purchase the stock or the investment. Now, there might be some gains, there might be some losses on it, depending on how the investment done. But why this is important is because if it's no cost basis at all, basically zero, the amount of gains that you have on this investment will be taxed, right? Whether at short term or long term. Now, going back to that 366 days that we were referring to, anything sold under 366 days would be considered short-term capital gains. Anything sold after 366 days would be considered long-term capital gains. Now, why that matters is really how they are going to be taxed when you sell them. So, if you do sell them at a short-term capital gains, they're going to be taxed at ordinary income tax brackets, right? So that might fall for you maybe within 24, 32%, maybe even 35%, just depending on how much income you made for the year. Whereas if it's considered long-term capital gains, the taxes might be around 15 or 20% at the highest, once again, depending on how much income you're making. With majority of times, you're going to be within the 15%, right?
Yeah.
So comparing the short-term and long-term taxes there, you might be saving, 9% if you're within the 24% tax bracket, or even more if you have higher income.
Yeah. And when you say that, right, it's important to note that, like, right now, like had you bought in March of last year, your positions could be up a whole lot, right? Because in March of last year, markets were down 30%. Let's say that's when you started investing. Even had it just recovered in general, you would have been up 30% there. But let's say you bought into NASDAQ at the end of March. Good for you, right? But you're probably also up something like 70 or 80% in that position, which, if you look at it, you don't want to not sell something just purely because of tax. At the same time, you're 11 months into this holding period that Raymond is talking about that could potentially save you 10, 15% tax on the difference between long term and short term. So you want to make sure you watch out for that. Now,
Yep.
is there something that you can do within the account, Raymond? If I bought, let's say, an ETF that I bought it 4 times across different periods. Okay. Some has more gain than others. Is there a way for me to choose which ones I sell? Do they have a default? How do I think about that?
Yeah, so there are going to be different methods of when you sell investments, and usually the default is going to be something called first in, first out, so FIFO basically. But with this method, once again, if you're at Schwab, you're at TD Ameritrade, Fidelity, usually this will be your default, indicating that whenever you first bought in, that's what they're going to sell first. Now, usually, if it's been held for a long time, that might be already considered long-term capital gains. But we also must consider that if you held it for that long a period of time, that probably has the most gains as well, right? So that's one method. Generally, you can also change it to other ones. There's also one called an average cost basis, where they're taking all your purchases together and averaging that out. So that's one easy way to just have an average cost basis when you're selling. The other one is going to be LIFO, so last in, first out, right? So the most recent purchase that you put in, that's the first one they sell. And the reason why you might want to do that, even though it might be considered short-term capital gains, is that maybe there hasn't been that much gains within the past, 3 or 4 months since your last transaction. So those are three ones that are automatic for you. There is a fourth method that you can change it to. It's also called specific tax lots.
Mm,
So from Alfred's example earlier, if we bought 4 different transactions throughout the year, we can actually select this method and say, hey, I actually want to sell from this specific tax lot or this specific transaction when I bought it. So your goal here is really to find the one that has the least amount of gains, whether they're long term, short term, but the one that has the least amount of tax implications on there. So definitely more control on what you can sell. But in either of these methods, right, we're really looking for a way to be tax efficient for that year.
yeah. And again, one's, to be honest, I don't know
Mhm.
that many people know that there's this like selection, right? They just go in and sell it, right?
Mhm.
And so I think it starts by understanding that number one, you have to pay some taxes on the gains that you have, right? That's the first thing. You
Mhm.
can check that by going into the history, or usually there's a tab called cost basis and see how much gain that you have. And then when you go to click to sell, if you don't select anything, it'll default to whatever the system is. And that's usually, as Raymond said, first in, first out, or FIFO. But if you're someone who's more hands-on and wants to select this, you can actually go in and use the specified lot method, right? Now, of course, if you ultimately sell everything, then it doesn't really matter, right? Because the specified lot, you sell one and then you sell the other three, it's still all the same. But it's more for someone who has an approach that they know they want to keep a certain amount. They want to reduce maybe their exposure because something has gone up a lot. You can then specify which ones you want to sell,
Exactly.
right?
Mhm.
Anything else to add to the kind of initial selling portion of it before we jump into the top five, I want to call them tax mistakes, but top 5 things to watch out for as we file taxes?
Yeah, maybe just one thing. I mean, when we're talking about selling between short term, long term, that shouldn't dictate whether
Hmm.
you sell a position or not, right? If we're probably a couple of weeks away from being long term capital gains, then sure, like maybe it's worth waiting for that, right? Because of the tax difference there. But if we're 1, 2, 3 months away and you just feel like the stock's not doing well, we shouldn't wait for long term capital gains because we just don't know where that stock's going to go. Right. I
Yeah.
mean, the loss in that stock itself might already outweigh the taxes that you could have saved by being long-term capital gains. So
You're telling me I should have taken my short-term gain on GameStop is what you're saying.
yes, exactly, right? I mean, if you guys were part of the GameStop and went to wait for a whole year because we're expecting it to go down, like that's something where that exact example applies in that situation. So we shouldn't let it dictate whether we hold on to a stock or not. It's just whether we think the performance is still going to do well. So
full disclosure, I didn't buy GameStop, but just saying, right? All right. So thanks for the tips there, Raymond. I think it's good to review that as new investors are getting into buying and selling, and they're going to have to deal with some of the taxation. So now let's talk about then what are the top 5 things that we see when we review tax strategy for somebody in terms of just like what they did from an educational perspective. Again, we're not the ones preparing the tax returns, but clients would like to learn from the tax returns. So we help them understand what's on the tax returns themselves. So what's number one? What's number one on the list when we talk about making sure things are done correctly?
Yeah, and the very first thing overall is just to make sure that we actually collect all of our tax documents, right? You'd actually be surprised where maybe there's just so many accounts that you had. There was a lot of different things going on last year, but you might have missed one account, right? And even though it's just one account, an amendment is usually pretty costly, so we want to avoid that. So anything above all, first thing we just want to make sure that we collect anything that we had in terms of income from last year, whether it's interest, whether it's dividends, generally from TD Ameritrade, Schwab, Fidelity, with the bigger custodians, they'll issue you out a 1099 to help consolidate things for you, to let you know how much gains you had last year, any losses, dividends, interest. Of course, you want to collect your W-2s if you're working, or you're self-employed, all the income that you had there. Even rollovers, right? If you're rolling over from last year an old 401k into an IRA account, that's still considered it's a non-taxable event, but you still need to report it, right? So there's still going to be a form that gets distributed to you. And given how things have been going, like things get lost in the mail, right? And if you don't keep track of it, that's something that's going to get missed, and you're going to have to amend your taxes, right? Roth conversions is another thing that issues a tax document as well. When you convert from IRA, from pre-tax to post-tax, any IRA distributions that you took out, maybe you needed some funds last year from your 401k or from your IRA accounts, that is a taxable document that should be generated for you. So, first thing, just making sure we keep an eye out for all the documents. We're collecting everything throughout the year and then filing it accordingly.
When you said that, I just remembered how many things that could be coming. Okay. And we're not even, personally, it's difficult to keep track of. So make yourself a list. Like, do yourself a favor, right? Create a table on a Google worksheet or spreadsheet. Just be like, here's all the accounts that I have. And start checking out to say, did you receive it or not? Now, they are getting a lot better at giving these tax forms digitally. And in fact, if you're using something like TurboTax, right, they allow you to link the account, right, your login, and it'll automatically pull in the tax form too. And it's certainly helpful. But I definitely see that as like one of the main reasons that people get audited. And it's not even because they're doing anything crazy on their taxes. It's just they forgot this one form, which maybe had $100 worth of like interest on it. Okay. But then what happens is they audit the whole thing. And then they just say, hey, well, what about this, this, and this, right? They don't audit just because of that. It just triggers a potential audit, which then they look at everything. What's crazy is also, right, like the systems are built so that it's really lagged behind. Like if you miss something, you're not going to know for 2 years.
Yep.
Right? Like they don't send you something and say, "Oh, you missed this." No, like they go through their process. It's going to be 2-3 years before you even find out that you missed it. And then lo and behold, if you did miss it, you can't correct it. There's interest and penalties that are automatically tacked on, even if you didn't know, right? So watch out for those tax forms. Minimize your chance of getting audited, right? Because that's their record. Right? Somebody else sends them that same form. And if you don't include that on your tax return, then guess what, right? There's a discrepancy. It's an automatic red flag.
Naturally reminds me too, in terms of time frame, where we've seen with our clients where tax documents actually aren't even generated until April, right? And, some individuals or family households that want to be proactive and file their taxes immediately. It's unfortunate that there's another tax form that came out late that they have to amend it now because of that. Yeah. So as Alfred mentioned, it's good to have a list of, things that generated income, distributions, so that way you can keep track of it. And if you haven't received it yet, it's definitely worth reaching out to that custodian or whatever that financial institution is to see if it's been generated or it might have been lost in the mail. So
Mm-hmm. And just be aware. Like if your taxes are simple, filing early makes sense. If your taxes has investments and other things, filing early may not make that much sense just yet because these places that generate tax forms can issue corrected versions of it a month later. Like they may send you one in February and then they send you another one in March because it's corrected, right? So you might want to be careful on that. All right, give us number two, right? What are we looking for in number two?
yeah, so now that we actually have our documents, and if we're, for example, using TurboTax or sending it to our tax accountants, that's when they'll start to fill in with all the information provided. So just making sure from a cost basis perspective that any adjustments are correct on there. So that's one thing, just to double check things and do your own due diligence there. There could also be like mortgage adjustments to be aware about because of the $750,000 limit that was changed from the tax laws. And then there's cases where it's a missing cost basis, right? Sometimes it hasn't been filed with the financial institution and it comes up with a zero cost basis. Now, as I mentioned earlier, if it's zero, that means that the IRS is going to think that all of it's going to be gains, right? So you're going to be
Mm-hmm.
taxed on that full amount, which is probably not the case because you probably put in some initial investment
Yep.
in there. So generally, a tax accountant will help find that if they see something's at zero, it just doesn't make sense there. TurboTax does a pretty good job too. If it's something missing, they'll let you know. But definitely rely on yourself too, just to make sure that there's nothing missing and everything looks correct.
Surprising though, right? I mean,
Mhm.
you would think what's on the tax form is what I enter and thus it's correct.
Mhm.
Sorry to break it to you guys, right? There's some manual work that has to be done sometimes, and you have to be wary of that, right? Like you have to look at it and say, check out. I mean, again, to Raymond's point, TurboTax does flag certain things, but many times I just see it completely missed or they ignore it. They don't know, someone doesn't know how to fill it out, but it costs them a lot of money if they are saying you didn't pay anything for it, which means the whole thing is taxed, right? And quickly, the mortgage one can be key too. When you have a large mortgage since 2018, right? Only the interest associated with 750,000, as Raymond said, can be deducted, even though your mortgage interest form completely shows the full interest. You have to actually go in and make an adjustment. That's another thing that can cause an audit there. Okay. All right. Number three. This is a popular one lately with people moving out of state. So Raymond, give us number three.
Yeah, number third one is going. This is going to be, especially from what's been happening last year with the pandemic. We've seen people be moving out of state. So if that is the case, just making sure that we're adjusting for income in both states, right? When you're in here, in California, for example, or if you move to Colorado, we want to make sure that we're accounting for both taxes there and prorating it correctly and not double counting it.
Yeah.
So I think TurboTax actually makes you adjust this yourself in that case.
Yeah. Yeah. And again, just a quick reminder, right? We are talking about this not as your tax professionals. It's really just so that you can ask your tax professionals these questions and
Mhm.
or ask these questions in TurboTax. Like this is more just from a education standpoint about what to be looking out for, right? And that moving out of state one is a key one, right? Like, I've seen people ask me, how come my state taxes seem so off? I thought I made the adjustment. The adjustment in TurboTax is completely manual, right? Like you're literally typing in what you think was income in one state versus another. There could have been a typo, there could have been a wrong adjustment, yet it doesn't really say like that is correct or not. It just assumes that you're making the right adjustment. That's where you should probably ask for some help or go into TurboTax, get their services where you can get some feedback. But that's a key one that we see. All right. Number four. All right. Number four has to do with maybe those that were looking for extra sources of income last year, right? Someone who maybe was working outside of their day job, which is their, what I call just a pay stub, getting it from an employer. What happens if you receive some, whether it's consulting income, some contracting income? What should we be doing there?
Yeah, so this fourth one is going to be about self-employment income, right?
Mm-hmm.
So if you did receive any side work or some contracting there, it's good to keep track of any expenses that you incurred throughout the year, whether it could have been supplies, traveling, meals, anything like that that you can add as an expense to deduct it from your self-employment income that you received for the year.
Yeah.
Also going to be important to keep track of, or be setting aside taxes for that as well, right? I think it's easy to get used to being with W-2 income and having taxes withheld for you. But for self-employment income, we just want to make sure that we are keeping taxes on the side, because there are going to be taxes owed come tax time for that.
Exactly. And keeping track of course, the income that's coming in, being able to associate any expenditures that you have had with that job is also key, right?
Yep.
And so I think the common misconception here is I need to have formed some business entity, whether it's an LLC, partnership, whatever it is, to be able to write off expenditures, right? And so the reality is, if you're doing it by yourself, there is an entity called sole proprietor. You're just your own business. There's right, and you don't have to go file any complex LLC things to be able to write off expenditures. You still have the ability to use a tax form in your taxes to say, here's my income from this business or my contracting, whatever it is. Here are some of the expenses associated with it, right? And that could help out your taxes as well. Okay. Number 5, final one. All right. Give us the 5th one, Raymond.
Yeah, so this one's going to be just deadlines.
Yeah.
We just want to make sure, as a reminder, that taxes are not due July 15th this year, as it was last year, because it was extended because of the pandemic. It's going back to April 15th. Actually, had some clients think of it as July 15th. So wanted to clarify that. Also, for deadlines for April 15th, this has always been the case, but keep reminded that any IRA or Roth IRA contributions that you plan to make for the previous year or for 2020, that we are making it into the account by April 15th. Any recharacterizations where maybe if you made a mistake in putting into an IRA or a Roth IRA and need to take it out, that also needs to be done before April 15th to resolve that issue. And the last one is going to be making sure that we pay taxes. Right?
That's right.
Penalties or more taxes than we have to pay, but just know that even if we file an extension, which generally allows you to file taxes on April 15th instead, that you still need to make your estimated tax payments by April 15th. So I think that's something common that.
And I think you meant filing extensions for October, right? Like, so like
Correct, correct.
yeah, it's extended out, but you still owe the taxes, right? Like, and people are like, well, how do I know? I was like, well, you got to make an estimate, right? Because if you don't, just because you file an extension doesn't mean it's not due still. I think that's another big misconception there. All right. So hopefully that helps you guys at least start thinking about, right, the ways that, you can file not only your taxes correctly, making sure you're not owing more than you need to. That's definitely a big one, right? Getting the right deductions in. And those 5 things should help you there on your way to at least start better understanding what you should be looking at. All right. Cool. So final things here as we close out the meeting. We understand that not everyone has the ability to work with us one-on-one. So we've talked about this a little bit. Okay. We've talked about a little bit about our day planner that we've launched, right? But more importantly, we've actually also just launched, right, individual e-courses that you guys can sign up for, right? So they have its own dedicated topic, dedicated course. Let me share with that a little with you guys right now. So what you'll see here is this is the day planner, right? So a little bit of what we've been talking about. Go ahead, you can go to Amazon and take a look at that. We've launched not only the annual version, but also, right, the quarterly version. So maybe you're not ready for the full year yet, right? And you want to take it step by step. Here is the quarterly version that you could be looking at for different topics. Now, this is something that I'm really excited to show you guys, right? It's our learning site, learn.diversifycapital.com. We've built out a lot of different bundles and individual e-courses that you can sign up, but we realize that sometimes you may need more than one course. So we've bundled them together for categories, whether we're thinking about home purchase, someone who's a recent college grad, someone who's looking at starting a new family or did start a new family. You can actually go into these and see what we've included as key topics to be thinking about. Okay. So this is something that you guys can go in. It's a one-time cost that you guys can sign up for, but it also continues to help build out the education that we've talked about in a more specific manner. Okay. So as our promise to you, we wanted to continue to launch efforts where we're making more content, more education available to a wider audience. This is part of that movement for us, and we hope that you guys can take advantage of that. All right. Thank you again for joining us. What do we got going on next week? Well, we've got another part of our real estate series coming up next week. We're going to be chatting with a couple of our partners again and a new realtor that we're working with out of Boulder, right? So a different part of Colorado. And as we move this series along, we're going to be talking about real estate in different, of course, parts of the country, but we're working our way across different regions. All right. Thank you again. Love doing these shows. It's always nice to end a Friday this way, getting to stream live here. Thank you, Raymond, for joining us and giving us such great tips on the tax side.
Yeah, thanks for having me again. We'll have a great weekend, everybody.
All right. Thank you so much. Have a good one.